UK stocks I'm buying February 2024 edition. This is one of the most popular video series I do on the channel, and this is where I go through all the stocks that I've been buying and selling in my UK portfolio, and I have been buying and selling. Now this just keeps all the transparency so you guys know the moves that I'm making in my portfolio from the 1st of January to the 1st of February. This just keeps all the transparency. There's nothing kind of getting hidden out in the background. I'm not buying anything and then selling it out in the background and going, oh, I hope they didn't notice that one didn't work out. Every move that I make in the UK portfolio comes on this video every month, and that's probably why it's one of my most popular videos. So I hope you enjoy it. Let's get started. Now, if you do want to know what I'm buying and selling in real time, the place to be is on the Patreon. £5 a month, which isn't bad at all. You get a Discord to talk to 500 members about stocks, including me. You get 2 exclusive videos a week, sometimes more. I'm going to try drop 3 exclusive videos this weekend before I do go away on holiday for a couple of days. And it is the highest Patreon to subscribers out there on the stock market scene. So if you do want to join that, link is in the description. Only £5 a month, and you support the channel. And if you want some free shares to buy some stocks, join Trading 2 with a link in the description. That is personally the broker that I use myself. But getting on to the buying first, I'm going to save the selling towards the end of the video. JD Sports, I think you knew this one was going to be on the list. I think I even mentioned at some point talking about it on the YouTube channel that I am going to buy JD Sports in the coming few weeks, or I did buy JD Sports. Yeah, I think this is a cracking opportunity right now. I'm sure most of you guys know JD Sports. It's a high street and also an online retailer of brands. They also have the expansion into Europe and into the US. They are trying to crack the US market. And I've seen a few people say, well, they haven't really got a moat by them. And I'm like, are you kidding me? Have you ever been into JD Sports? Like companies like Nike have to sell through JD Sports in the UK because they are so popular. They would miss out on so much footfall and give a lot of that market share to the likes of Adidas. So with a moat point of view, Nike need JD as much as JD need Nike. And when you look at the recent trading update, we've seen a lot of brands like that JD actually sell, for example, like the likes of Nike, but a lot of other clothing, high-end clothing brands actually struggled during this last 12 months with the cost pressures pushing on them. And we've seen a lot of companies suffer big time, their earnings suffer. With JD Sports, the stock has actually been punished massively during this time frame, and yet we've not really seen that much weakness from the business. Yet the share price is going towards the sort of levels it was at towards the CV dip, and it was actually at the levels before the CV times. But yet you look financially, what this company has done in the last 4 years, if we do go on the past performance, look at the drive up in revenue and profitability in the last few years. Now, like I was saying, the stock has been downtrending because I think of other companies suffering, yet we've not seen any weakness in the financials of JD Sports. Now, we actually did see a tiny bit of weakness in the latest trading update, which is understandable because you've seen that other companies massively suffer for the last few months, and yet we've seen nothing with JD Sports. This was the first time we saw a bit of weakness. And yet, even though we've seen a bit of weakness, these results are still so much better than other companies like Nike, for example, in this space. They are still throwing off good amounts of profitability. They're still throwing off good amounts of revenue growth. Revenue growth was 6%. The gross margins were not declining. Now, they were supposed to grow, but they are in line with the last year period, which is not bad when you look at other companies in this space. When you look at the profit before tax, it's still going to be 615 million to 635 million. This is on a business that's currently valued at 5 billion. How impressive is that? And then when you start looking when the profitability is going to go up to 600 million-ish, should increase, revenue should increase as they carry on expanding through the US. You look at the company, cracking balance sheet. They only sit on 4.6% debt to equity. Yeah, the debt is like 114 million, while sitting on 1.4 billion in cash. Yeah, that's correct. They've got over 20% of their market cap in cash on the balance sheet, and there's no wonder why. They're a company that is throwing off 600 million plus in profitability. Imagine what they're going to be able to do with that. We've already seen some of that with the likes of the dividend, and the dividend being hiked up, which is really nice. Potential acquisitions, buybacks, really good amounts of profitability and balance sheet. And then you look at the insider front, no wonder insiders are queuing up and buying shares. There's been a lot of insider buys going on at the moment, and the most recent one on the 18th of January, the actual chairman of the board bought 50k worth of shares as well, and we actually saw the CEO bought around 100k of shares on January as well, which is really good to see. So yeah, I think when you're looking at JD Sports, 8 times earnings, and it's still doing these numbers in this environment where you've seen so many businesses killed. I think it's very attractive. Card Factory. So I did do a big increase in my Card Factory position. This was a stock that I was up around about 90% on. And in fact, if I actually hold my original average on this position, I would actually be up over 123%, but I keep averaging up and averaging up. I am now only up 40%, I think it is, on this position because I'm averaging up so much on it. I'm making it a larger and larger position in my portfolio because the financials have really come on. And I look at all this for 6 times earnings. Now, Card Factory, once again, you'll recognize this from the high street, seller of cards and cheap cards, especially in this environment where we're seeing the consumer be more conscious about money and trying to get the cheaper option rather than going to Moonpig. And as well as that, partnerships, they have been making a lot of partnerships with the likes of Matalan, for example, and expanding into other countries as well. The growth was 10% year over year. Yeah, Card Factory growing 10% at 6 times earnings, crazy. There's been a lot of focus on the online sales. They're saying that online sales was down 12%. That's a big issue. Not really. As we know, Card Factory is more of a high street store. If you go online, you go into the likes of Moonpig, for example. Online sales only makes up, I think, 3% of the actual sales of the business. So that's nothing to worry at the moment, in my opinion. Still making those partnerships. When you look at the recent trading, the outlook said that the board expects to deliver to the top range of the market expectations, which is absolutely amazing. And you look at the growth of the business and the profitability, 6 times earnings, very good. Balance sheet wise, in a lot stronger place than where it was a few years ago. They've been paying down that debt massively. And obviously when you're throwing off 40-ish plus million at 311 million market cap, what's going to happen is they're actually going to start bringing back the dividend, and you're also going to be picking up a nice dividend as well. With the insider front, you did get some insider buy-in in June time. The actual new CEO came in and bought a 80k worth of shares. He bought that at 91 pence. And if you actually do look at Card Factory right now, it's exactly where it was 6 months ago. So the stock has been pretty flat for the last year, even though financially they're growing at double digit. The profitability is very good. The balance sheet's getting the debt paid down, and probably going to come out with dividend very soon as well. Once they've had a few more loan obligations paid off that is stopping them from paying that dividend, and that's the strength of the balance sheet coming back. And yeah, I think Card Factory at 6 times earnings, even if you throw it at a discount of the market of 20 times earnings or whatever it will be, let's say you trade this at 12 times earnings, I think this is still a very fair valuation for the company and the financials they're doing. So yeah, Card Factory I really like at the moment. Supreme, so I was a bit 50-50 about buying Supreme, and it had a very volatile June. This stock moved massive. Now if you actually look at this share price drop here, so it was downtrending for a little bit, and then there was this drop off here in the share price. Now this looks like it's not really dropped off that much. Now realistically, on this day where it looks like it went to £1.05 and then £1.16, on that day, if you remember, I made a video on it on the YouTube channel. I think the stock swung around about 30% on that day. And even though it's not registered here because it was during that trading day, and obviously this stock chart only recognizes when the price is actually closed on the day. On that day, Supreme actually went all the way down to, I think it was 80 pence on that day. Absolutely insane. So the stock went down massive, and I bought around 80 something pence. And from that day, the stock actually rallied up to £1.16, and since that day, the stock has also increased a little bit more. So my buy was very, very low below where I'm showing you right now, and it's not even recognised on the stock chart. It was that low down. It had a bit of a panic because we saw the government ban disposable vape. And even though this has been known, for some reason the stock took a crazy overreaction, and I think it was down 16% on that day before actually rallying up. I can't exactly remember what it closed on the day, but it was up a fair amount on the day. And it was really surprising. It was a big overreaction because we knew this was going to happen. And the big thing is that the reason why the government is doing this is because they don't like vapes. It's that they don't like children getting it. And they think that banning disposable vapes will solve that. And what it seemed to create, and I've not seen this for a while, where there's this kind of conspiracy theory going out here, and I'll even see it on this video in the comment section, and I actually saw it last time I talked about Supreme. There was all these people in the comment section saying, oh, it's the end of vaping's so bad. It's not. They're dealing with that disposable vape and hoping that that puts children off vaping, which I don't think it will do, but that's how they're trying to tackle it. People are saying, oh, the reason why is because they're scared about the health of people that vape. I'm sorry, but it's not. If you look at the data, and this is on the NHS website, it clearly says that vaping is, at the moment, the data shows is healthier than smoking. So as long as that's going to happen, the government and the support will be not for completely banning vaping. and it will be to push people from smoking to vaping in the end. And as long as the data shows that, that's what will happen. I know a few people like the conspiracy theories, like the world is flat, dinosaurs still exist on Earth, vaping is bad or a lot worse than smoking. It just isn't, and the data is there to show it. And a few people thought, oh, because disposable vapes are banned, Supreme's going to suffer. No. Anyone that does vaping will just switch from disposable vapes to reusable vapes, and they probably won't see that much of an impact. And Supreme actually came out on the day when this was announced, and that's probably what caused the share price to catapult, is they then brought out a trading update. The trading update was once again absolutely insane. Trading now significantly ahead of financial 2024 expectations. 2025 outlook unaffected, and if you look at the numbers through, I'm not going to go through it all with you today, but the numbers were absolutely insane. And you're looking at a company here that, if I just go on the financial performance of this business, and you see the performance has been absolutely insane. And by the way, it's not just a vaping company. When you look inside the business, I know most people, and me included, mostly focus on the vaping side, but there's also the lighting, the health and wellness, the battery side of it. So it's quite a diverse company. The vaping is definitely the key driver of this business, though, is what I will say. But now the profitability they're throwing off, the revenue they're throwing off, you're picking this company up at 8 times earnings with a 3% dividend yield, and you're looking at the company that's just come off a year where they've gone from 144 million up to 225 million. Financial health wise, throwing off a lot of profitability, got a decent balance sheet as you can see here, and once again you've got an insider buy. The CEO did pick up nearly 500k worth of shares. That's a lot of shares, on the 2nd of October at £1.28. And once again, if you actually look at where the share price is, the share price is below where he actually bought 500k worth of shares. So yeah, even if you say that this trades at a discount to the market, it's still, in my opinion, at a very good valuation right now, and that dividend is going to grow as well, and also the buying back shares, which was recently announced. AlphaWave, so I did buy some shares in AlphaWave. The last few days, the stock has been ticking up nicely, being on a very good run. AlphaWave is a producer of silicon IP, chiplets, custom silicon, and connectivity products. So they are obviously going to try to take advantage of the growing AI demand, data centers, and if you look at the recent update, I thought it was pretty good, and this is what led me to go buy some shares. Their license and NRE bookings were up 245%. They had 7 new design wins, and they actually got a new partnership with ARM. They confirmed their outlook as well once again. And if you actually look at ARM's results, which sent the stock up 47% yesterday, probably why it's giving AlphaWave a bit of a lift up today. And AlphaWave is kind of my play into the semiconductor space, and if the semiconductor space does very well, I would hope AlphaWave do exactly that. I think ultimately the long-term plan is that I think AlphaWave will be bought out by someone. I think when you look at the company, it's around about $1 billion market cap. I don't think when you look at the products they're producing, I think that eventually it might get to the point where someone takes a look and thinks, you know what, if we give them a 2 billion bid, 3 billion bid, I think they'll take it, and I think we'll all be happy as shareholders. And if you actually do have a look at the management team and the past, which by the way, they have a fantastic past. If you look at Tony's past history of managing companies, a lot of his previous companies have actually been bought out as well by, I think it was Intel bought one of his previous companies. So I think that that's potentially the exit plan that he would maybe look at as well. So yeah, I think that's probably where AlphaWave will probably end up anyway. Next one is Darktrace. So Darktrace is my play into the cybersecurity space. Cybersecurity, massive area. We're seeing so many more attacks, especially with what's going on in the world. We're going to probably see more need for cybersecurity. The stock has been a bit stagnant in the last few months, although overall I am up on my position around 20%. But I have taken advantage of the dip that happened during this time frame to buy a little bit more shares in Darktrace, and I did do quite a bit of a big buy to increase my position. They do a few products like Prevent, Detect, Respond, and Heal, and they actually came up with a recent update which was on the 11th of January, and it was a good update. I thought this might help the share price kind of kick on a little bit, and it hasn't really, which has been very strange to see. But hey, you know, if the share price stays here for lower and it keeps doing very good financials, I'll carry on buying some shares. And I also thought what was surprising is that in this time frame where we're seeing a lot of companies be a little bit sensitive on what they're actually spending the money on, that they're still doing these numbers. You know, you've seen like the likes of Fortnite, for example, struggle in this time frame, and the numbers were pretty good. They actually raised their financial year guidance as well. They had growth of 27%. EBITDA margins were going to be at the top end of what they previously guided for, which is really good. You look at the company, growth has been insane. Obviously, the profitability is starting to ramp up, free cash flow starting to ramp up. By June 2025, if we're doing about 150 million in free cash flow, we're going to be picking up this company around about 19 times free cash flow, which isn't bad at all. When you look at the balance sheet of the company as well, good balance sheet. The company has no debt on it, sits on around about 350 million of cash, and obviously it's profitable, so it's going to be throwing a lot more profit down to that balance sheet as well. So yeah, once again, you're sitting on a company that's probably by the end of the year going to be sitting on around about 20% of its market cap in cash with no debt there. So yeah, I'm really happy where Darktrace is at the moment. Next one is Money Supermarket. So this stock actually had a bit of a drop because Jefferies came out and downgraded it. They said that they're going to struggle for growth this year because they have hard comps with the insurance space and how hot it was last year. I was like, that doesn't really deserve the stock to go down, and it is a very diverse stock, but it did really start to sink the share price a little bit. You can see here that since that downgrade has happened, it has had 11% drop, but I think this puts it at a good valuation once again. 17 times earnings, nearly a 5% dividend yield. I did get to the point with Money Supermarket where I was like, I want to buy heavy at the £2 range, but since this drop here, I've just kind of gone, I've been waiting for like a year for it to get back into like the £2 range. I don't know if it's going to get there, so this was my dip that I thought I'm going to try buy quite a few shares on it. The way I bought a lot of shares in this dip is I actually sold or trimmed a stock by 20%, which is towards the back end of this video. They are a comparison site. Obviously, people are more conscious about the money, comparing how can they save money, offer a lot of products, as you can see here. Also means that when there's a weak time frame, so for example, they're suffering at the moment from the energy market, when that's struggling, hopefully something else kicks on, and we've seen that with the likes of travel insurance or any other insurance where a lot of these premiums have been going up in line with inflation. You look at the recent results, I thought the recent results were very good. You can see clearly the insurance drive was the driver for the growth this time round. Home services, as you can see here, still not showing any signs of growth with the energy market, but that's a key driver that's going to come back in the coming few months, and the revenue will easily double from where it is at the moment once that kind of starts coming back. They are actually going to bring out a full year of results on the 19th of February, so I'll keep that one nice and brief because there's going to be a lot of outdated information very quickly on this one. But you can see here the company has a great track record of growing the revenue, and the profitability they throw off is very good. A little bit of a dip with the energy market and the travel side of it with the CV situation, but all that's starting to come back, and we're going to see that energy market throw a lot of revenue back into the company and profitability. Balance sheet wise, once again, cracking balance sheet, throwing off a lot of profitability. Dividend that will get increased as well. On the insider front, there was a few buys just over 12 months ago, so they're not going to show on here, but there was a few insider buying as well, which is good to see. And my second last one was Aviva. This is a very defensive play for me. It's just one that I want to collect the 7% dividend. I think I'll get a bit of share price appreciation as the profits do tick up slowly going forward. That will be just from probably hiking up a lot of their insurances in line with inflation, and that's what Aviva does. I'm sure most of you have seen them: car insurance, home insurance, life insurance, pensions and investments, and healthcare insurance. And as you can see from the recent update that they did on the 16th of November, mostly moving in line with inflation. They're putting a lot of their insurances in line up with inflation, and that's what it'll do. It'll just nicely tick up financially because of that, and as well as that, when it has the little increased profit, they'll throw that to the dividend and you'll get a nice dividend. What's also nice is it is trading below its normal valuation at the moment. It hasn't recovered to where it was before the CV situation, and it did get up there in 2021 and has a bit of a discount at the moment, so it is a bit below its normal valuation. And also there was speculation that they were going to get bought out. They were going to get bought out for a £6 a share. Now it seems like it hasn't gone anywhere because this was 4 months ago, but I thought with this talk about potentially a £6 buyout, I thought that would be the ceiling, that we see the stock at least move up to £5 from here, and it hasn't. So really surprised by that, but realistically I only have to collect the dividend here and a little bit of share price appreciation, and it should get the market or the S&P's average return from just holding it. The last one that I bought was Team 17. Made a video on it the other day, so I'll keep this nice and brief. Team 17 is an indie game developer and producer with games that have great reviews. They had a profit warning, and that's what caused the stock to go low. I thought it personally went way too low. It actually went below where it was below the IPO, and you can see from its highs in 2021 it was down massively. Even now it's still down 70%, and I thought, this is a bit too much of a sell-off. What happened is they came out with a profit warning. They said basically some of the games that we thought would do very well haven't done well, and it stung them massively. I was waiting for another trading update for them to come out and say, actually, we've seen it stabilize now and the numbers that we're giving you are correct. And they did bring out a update saying, yep, no more profit warning, we're okay where we are at the moment, which was my indication of, right, if they're going to go back to the old amount of profitability and they resolve some of these poor performing titles, I'm going to get this at a nice valuation here. So I did pick up some Team 17. And that's all the stocks that I bought. I was definitely a lot more active on the UK side than the US side this time round. Now, obviously there's a lot of buys, so that did mean that I had to, or I did, sell a few stocks that generated the money to buy some of these stocks. And the first one was Forterra. I covered it the other day on the YouTube, this week on the YouTube channel. So once again, I'll keep this nice and brief. Reason why I sold is not because I don't like the business. I've had a few people actually comment saying, oh, I don't know if I should sell. I still think Forterra will be okay. The only reason why I sold is that I just felt like having Barrett and Forterra in the portfolio was a bit of a bad combination. Compared Forterra to Barrett, the other thing is that the balance sheet was weakening a little bit. I also didn't like that the insiders were not buying at all, and in fact the only thing that happened was the CEO sold some shares. So with all them sort of factors, I thought, you know what, I want to move this cash to somewhere else where I think there's a better opportunity, and that was Team 17. So I did sell out of Forterra. Next one is Mobico. So I did sell around about 20% of my position in Mobico. The only reason why I sold it is because out of nowhere, I don't know how this has happened, I was about break even on my position. The stock has been, since the last profit warning, which I bought heavy on and I averaged down massively on, the stock has been on a massive rally. The stock is up 54% since that profit warning. And that actually put me into break even. What has made me laugh is that I've seen a few people in the YouTube comments going, oh, he's down 70% on Mobico Group. And I'm like, I don't know where you're looking, mate. So I'm about break even on this position. So anyway, I did sell 20% on my position. The reason why is I just bought really heavy on the profit warning. And now that I was at about break even, I thought I'm a little bit too much exposed to Mobico where I'd like to be. So I'm just going to alter the position now that I'm break even. And I did sell around about 20% on my position. Since then, it has actually dropped back again. So I don't normally catch the top or the bottom of the market, but it seems like that did happen. The 20% sell from Mobico was the one that went directly into Money Supermarket, and I increased the position in Money Supermarket with the capital I sold from Mobico. So yeah, I still got the position. I've just trimmed it by 20% because I just felt like I was a bit overexposed after buying quite heavy in after that profit warning. And the last one was Supreme. So same again with Supreme. I saw the stock dip that I talked about earlier, went all the way down to 80p, did a big buy, and what I did not expect is to see the stock go from 80p and finish the day up at £1.16. So I averaged down massively, and there was up on the position. And once again, I was like, okay, I did not expect that to happen. And also, I'm a little bit overexposed now, have to buy in very heavy on this dip here. I need to just balance out the position a little bit. So I did take a little bit of a trim on Supreme with the cash that I did originally put in. Got my average down and also made a bit of profit on it, which worked absolutely amazing. So I know a few people will be typing in the comment section going, day trader. But hey, sometimes, you know, when those little things happen, I think it's good to just balance out the portfolio, even if you're a long-term investor like me and I'm holding a lot of these stocks for 3, 4, 5 years. Sometimes when you just see moves like that and the stock's swinging around 30%, you're talking where you're expecting a year's amount of returns from being in that stock happening in a day, and sometimes you just got to alter that even as a long-term investor sometimes, and that's what I did with Supreme. Anyway, that's the video for today. This is a long one anyway, so I hope you enjoyed it anyway. Hit the like button. I will be back on Monday, so have a great weekend. See you all in a bit.